Good morning, everyone. Welcome to our third quarter market review. Happy Monday. Thank you for joining us at this bright and early Monday. We know you could be anywhere in the world, but you decided to join us, and we truly appreciate that. So for this webinar, we figured we would talk about it was a busy quarter as far as what was going on in the headlines and in the market. So we figured we'd recap the performance of what happened across the different asset classes. Then we'll shift gears and talk about the different news headlines that move in markets. And then we'll give you some tips on how to be a smart investor. So, look forward to that. We are your experts. And I like that term experts because, we're not your hosts, we're your experts today. I am Devon Barrett, lead advisor at Francis Financial, been with the firm just over 7 years. So time flies when you're having fun. And I am privileged and honored to be joined by my esteemed colleague, Shweta Lawande. Morning.
Morning, everyone. So nice to be speaking with all of you this morning. And Devon, as Devon mentioned, we have a lot to go over this morning, a lot of great stuff. And a good place to start is let's recap what we saw in the third quarter across the board, really. And this quarter was a bit of a round trip for investors, especially when it comes to the US stock market. First, we saw new highs in the market just before falling back to where it had been about 3 months earlier. And the setback that we saw was largely the result of a lot of new developments in the market, a lot that we'll touch upon later this morning. But the big ones that investors were really grappling with were, the Delta variant and its impact on the economy, supply chain slowdowns that led to shortages across different industries, and worries over China, which, as you can see, really brought down emerging markets in the third quarter. And we'll talk about each of these developments in more detail, but overall, in the US stock market, both stocks and bonds are little changed from where they were in the second quarter. That being said, if we look at the overall year, even despite the setback that we saw, stocks are doing fantastically well this year. And in contrast, and what we might expect to see when stocks are doing particularly well, the bond market is continuing to dip, especially after the Fed recently released their inflation forecast, which was higher than expected. And they also indicated that they could raise interest rates next year, which Devon, I know we'll talk a little bit more about. So overall, if we think about the year as a whole, we're doing great, even despite the setback that we saw in the third quarter.
Right.
Here we can see returns around the world by country, and you can really see the impact that China had on the emerging markets volatility that we saw in the third quarter. And you'll often hear Devon and I and almost everyone at Francis Financial talk about how important it is to stay diversified in your investments, particularly in your exposure to stocks. And I think this quarter was just a great example of why global diversification is so important in reducing overall risk and creating steady returns in your portfolio. And similarly, diversifying your exposure in growth and value stocks is important. And I'll let Devon tell us a little bit more about that.
A great segue, Shweta. It's almost like you knew what the slide was that was coming up. But yes, it's absolutely important. It's absolutely important to think about the diversification within your stock sectors as well, because over the last 10 years or so, I really post financial crisis that growth stocks have been on a fantastic run up, and you can see that on the left side of the chart. That there's been outperformance across the board between growth and value. So investors love growth stocks, especially even in the pandemic. We went into that technological age where now everybody's taking meetings on Zoom, and the implications of that we saw, contributed to that performance as well. And the growth stocks are sexy. They're talked about. They're the ones that are in the news. Investors want them. Everybody wants Amazon and Tesla in their portfolio, and the FANGs, the Facebook, Amazon, Apple, Netflix, and Googles of the world have really buoyed that slice of the market. But finally, we're starting to see some reversal year to date, as you can see on the slide. And the third quarter was really stark as well for the shift that we, in September, when the market had a pullback that we'll talk about later in the presentation. Growth really took a hit, whereas value kind of maintained its value a bit, no pun intended, value maintained its levels a bit better there relative to growth. So what does that mean? The experts are saying that the tides are turning, markets are cyclical. So many believe that we're going towards an era where value is going to outperform for the foreseeable future. And value tends to outperform in times of above average economic activity. like rising interest rates or like rising inflation. And spoiler alert, those are two topics that we're going to talk about that are in the marketplace right now. So what does this mean? Does this mean that you just abandon growth and go all into value? No. No, that means it's time to keep a healthy balance between the two. And if you're like many longer term investors, if you let your portfolio kind of just ride out the waves of the market, your growth stocks have probably become an outsized portion of your portfolio. So now would be a good time for a rebalance, right? To take some of those gains in the growth space off the table and then reallocate them into value, selling high, buying low, and then you're perfectly positioned for the future, whatever it may come. So you don't have to speculate, well, is it going to be growth? Is it going to be value this time? Doesn't matter, your portfolio is ready for either. And then when we think about rebalancing, if you think about, taking gains off the table or putting cash to work, well, you're looking, well, where can I find the best deal? Well, unfortunately, it's not in the US. There's been, as I mentioned, the run up since 2008 has been fantastic in the US space. Fantastic is almost an understatement if you look at the chart. So the gap between the US performance and the rest of the world has really widened in that time frame. And that outperformance has only gotten more stark in the pandemic because, as you can see, there was that sharp decline in March of 2020, but that wasn't contained and isolated to the US. That was a global phenomenon. So all the prices across the board went down. And the US, because of, positive vaccine rollouts and a quickened reopening and just, lower, just a good response and federal stimulus that we'll talk about as well, we're seeing that, the US recovery has been very quick relative to other areas of the world. So that outperformance has only increased. Emerging markets was neck and neck, but as Sweta just showed you, that reversal has already started because of some, issues in China in the marketplace that we'll talk about. So right now, the PE ratio, the price to earnings ratio, so the price that a stock is trading at relative to its earnings, are showing that, US is historically overpriced. So this is not the area to get a cheap dollar, so to speak. So what does that mean? That means if you're looking for a bargain, like many of us are, international would be the place to turn. International stocks are relatively cheap comparatively. And that's for the opposite indicators that I just mentioned. There's been underperformance in the last decade. So investors are looking to the international for a run up. So that means their money is going into that to raise prices up a bit. And the short-term recovery has been uneven, like I mentioned. Vaccine rollout hasn't been as smooth as expected, and the reopenings have been staggered. There are some parts of the world right now that are still in very stringent lockdown. So there is the opportunity there for that recovery that we've already experienced here and in other parts of the developed world. So international stocks are the place to go if you're thinking about maintaining a healthy balance. Again, I'm not saying sell all of your US and plow all of it into the international, but I'm saying maintain a healthy balance between the two.
So let's dive a little deeper into some of the big topics that investors were thinking about this quarter. And, a lot of these may seem familiar to you from news headlines and other sources. And what I often see when I'm perusing through the channels and looking at the news is in service of being salacious about the news, sometimes I see news sources really overextend themselves in how they think that these events are going to impact the market. And something that you'll hear Devon talk about when we do a dive into some of these different events is, the market does a great job of taking into consideration these events when prices are being determined. So investors are simultaneously grappling with these issues and pricing them into the market. And it's that constant back and forth that we see that makes it difficult for us and institutions and news sources to clearly delineate how each of these developments is currently impacting the market and how they're going to continue to impact the market in the future. But some of the things to keep in mind as an investor is the Delta variant and how that's impacting our economy, and a bit of an optimistic turn here, which is different from the way we've had to speak about coronavirus in the past. But after we had made substantial progress in reducing the number of cases and fatalities in the spring, we saw the pace of vaccination start to slow down, and the much more contagious Delta variant caused a resurgence of the pandemic. But that being said, we now estimate that between infection and inoculation, somewhere around 85% of all Americans are have some type of immunity to COVID through these different sources. And that's absolutely fantastic. And as Devon alluded to, not all countries are on that path to progress just yet. And because of this fantastic development, and because many industries in the US and around the world are now adapted to working and operating in a pandemic environment, we can reasonably expect that pandemic-related issues are going to take a back seat as we move into 2022. And at the very least, they'll have a much less of an impact on the economy going forward. Government spending is also another important topic on people's minds, especially as Biden's American Rescue Plan, the $1.9 trillion plan, is working itself through the system and continuing to support the economy through the end of this year and into 2022. And we're seeing negotiations continue in Washington over additional support for infrastructure, childcare, education, a lot of great initiatives that have been supporting the economy through this time, and we expect that they'll continue to do so in the future. But any new stimulus, what we expect to see there is that it's going to be spread over a longer period of time, and it's going to be partially funded by tax increases. So what this is signaling to investors is that what we expect to see in 2022 and beyond is a healthier economy than what we've seen in the past couple of years, and one that will likely receive less government support as a result. There we go. Meanwhile, there's been growing concern that our policymakers wouldn't have been able to come to an agreement about raising the debt ceiling. And this concern more or less ended with a short-term resolution that will allow the Treasury to increase its cash buffers until early December. So very short-term solution to an overarching problem. And what this means is that until there's a more permanent fix for the debt ceiling issue, what we'll see is the Treasury will likely supply fewer Treasury bills, and that will in turn put pressure on short-term rates as the market continues to increase its demand for liquidity and the Treasury pulls back on its supply of liquid Treasury bills. And if you tuned into this presentation a couple of months ago with our colleagues Paul and Peter, this might look familiar to you. And that's because the Biden's capital gains tax proposal has been an evolving bill over the past few months. And what we were seeing a couple of months ago is not what we're seeing today in terms of what the new proposed tax rate is. And so in its current iteration, the new proposal is that capital gains and dividends will be taxed at a federal level at 25%, which is an increase from the current 20%. But again, nowhere near what we were seeing just a few months ago, close to 30% even at one point. So what we're seeing here is that this 25% capital gains tax rate will be applied to single people who earn over $400,000 and then married couples earning over $450,000. For people who are earning $1 million and above, what we expect to see is that capital gains tax rate will be closer to their ordinary income tax rates. That is all to say that this is currently just a proposal. It's still evolving. It's still going back and forth to come to a place where people can agree on it. And the process of agreeing on it is very difficult as the majority in Congress is currently razor thin, and any bill will need either all of the Democrats to support it for it to be passed or some type of bipartisan support. So this is something that we're continuing to track as it evolves, both the increase in the capital gains tax rate and how carryover basis will be treated at the death of an individual.
And that's something that we really want to double down on, the uncertainty around this, because we were having these conversations about a year ago when Biden was first elected. These numbers look much less onerous than what we were expecting at that time. No one loves a tax increase, like that's not ideal for anyone. But that being said, these numbers are looking much more reasonable than the 40, close to 40% that we were seeing across the board that some were predicting in January. So that goes to show you never know where this is actually going to land. So don't drive yourself crazy trying to predict what's going to come out of Washington, because it's going to lose in game.
Exactly. And we're seeing a similar game on the corporate tax side of the proposal. So, as for the corporate income tax rate, the proposed rate is now 26.5% compared to where the proposed rate previously was at 28%. So, we're starting to see, between all of the back and forth, we're arriving at a number that's much less onerous than was originally proposed. And along with the increase in the corporate income tax rate, what the administration is proposing is a global minimum tax rate for companies that deter their profits from the US to sheltering them overseas. So it's part of an effort to capture a lot of the profits that American companies are experiencing and then taking offshore.
Now, let's shift gears a bit and talk about some of the more speculative possible headwinds in the marketplace right now. The big one is inflation. We're getting a lot of questions about inflation. It's on the news all the time. And I like inflation because it's one of the more tangible economic indicators because you can feel it, right? Like if you, whether it's you're at the grocery store and you're at the checkout line and your tab is suddenly a little higher than you remember, or if you're like me and you're at your favorite Mexican restaurant, you notice that a margarita is now $2 more than it was at the beginning of the pandemic. You're starting to be able to feel the effects of inflation a bit, and there are a few reasons for that that we'll get into. Like, there's a lot of money floating in the economy that's in response to the pandemic, and there's some supply chain issues, both of which are really impacting the inflation in the marketplace. But the takeaway here is that you see it in the bottom. Inflation experts believe inflation increases are temporary. Inflation so we're not expecting to have hyperinflation, or we're not expecting to see inflation like we saw in after the Great Depression or in the 80s. We're expecting to see some moderate and healthy inflation. And I use the term healthy because inflation in and of itself, as long as it's checked, is a sign of a healthy economy, right? Like, prices going up shows that the economy itself is healing, considering where we were 18 months ago. So, as I mentioned, there is a lot of money floating around in the economy right now, and the Fed is actually preparing to tighten its monetary policy. That's to help combat inflation. There was money pumped into the economy, through various stimulus packages last year to kind of keep us afloat during these unprecedented times. And I don't want to use the term unprecedented because I'm sure we're all fatigued with that word now. So I'm going to try to take that out of my lexicon for the rest of this presentation. But specifically speaking, quantitative easing is something that the Fed has announced that they're going to pull back on. Quantitative easing is a process of, just buying, the Fed is buying government bonds to pump cash into the economy. And even during the pandemic, it took it a step further and was buying corporates, which was something that we hadn't seen. But they've announced that, we're going to start to taper that off, and they're going to, reduce that purchasing power 15 billion a month, which sounds like a huge amount, but that's going to get us out to about July of next year, which is the target for that. So that's one way that the Fed is looking to counter inflation, by kind of reducing that free flowing supply of cash. A healing economy says, what, it's time. Money can't stay cheap forever. And what does this mean? As I mentioned, it's less supply of cash. And then, I think the markets have reacted well. This is the big takeaway from this slide. The markets have reacted relatively well. And I think that's because it's, as Shweta mentioned, she said the key word earlier in this presentation, it's been priced in. I am a big believer in the efficient market hypothesis, meaning that prices reflect all relevant public information. So I tend to abide by that thought process, that if we're seeing something in the headlines or we're talking about it in this webinar, that's probably been priced into the market at this point. So the fact that we are talking about inflation and we are talking about this reduction of monetary, or the pullback of monetary policy, I should say, that means that this has been taken into consideration by investors quite some time ago. So that's why I strongly believe that the market has reacted the way it does, because of the way that this has been factored in already. Now, this is another big one that is causing inflation: supply chain disruption. So, we're in an interesting time where pent-up demand in certain areas of the market are already outpacing supply. We as a human race were locked up for so long that now, that depending on your comfort level or where you live, people are ready to get back out and, spend money on goods, travel, whatever that may be. So the demand is already high. And because of the pandemic and its rippling effects, we're seeing situations with closed factories, clogged ports, fewer drivers. So there is an up and down supply issue across the supply chain. So that's basic economics right now, right? We have higher than average demand and lower than average supply, which is really creating that bottleneck and raising prices and contributing to that inflation. Um, you know, considering keeping in the mind of the pandemic as well, the uneven kind of reopening has also been a contributing factor to why we're seeing some of these increases in prices of goods. Like, for example, a lot of the raw materials like lumber and steel come mainly from emerging market nations, like specifically India, Brazil. So when we have issues with the pandemic, reopening more slowly in those areas, now we're also having issues with supply of those. So anyone on this webinar who's doing a renovation of their home or building a home, I know you're feeling it. I know you're feeling it in terms of like the increased prices of these goods and also the time. We've been talking to clients and people are trying to do renovations or home builds, and they're picking the cabinets that they expect to have in a month, and then, oh wait, the delivery time is April. So we are really feeling these supply chain issues again as consumers in the market, and this is something that it's going to be with us for a while. So we'll just need to adapt. Less lumber means less paper, so there are book shortages. It ripples across the economy. So does that mean we need to run out and buy toilet paper like we did the pandemic? No, please do not do that again. But I think we can make adjustments, like, if there's book supply, try to get it on Kindle, try to get your Christmas shopping done early, because these are going to be things that we're going to be dealing with, and it is contributing to the rising inflation a bit. Now the other one, the age-old interest rates. So interest rates, this has been a topic that we've been discussing for years now, rising interest rates. And this is another one that, rising interest rates in and of itself is not a bad thing. Yes, it makes money more expensive. If you're trying to buy a home and get a mortgage, probably rising interest rates is not something that you want to hear. But it is also a sign that the economy is on the mend, right? Because what we're seeing from the economic indicators are corporate earnings are strong, job growth and employment levels are healthy. There's reasonable signals that the Fed is getting to, the economy is on the mend, so let's raise interest rates. And this has been a long time coming. We've been talking about this for years. And I say we as like the general we, not the Francis Financial we, but investors have just said that, well, interest rates have to go up from here. They have to. And then we saw the pandemic and then they went down. So everybody was wrong. But we know that at some point they have to rise. And originally, the Fed was targeting 2023. And now recently as of the last couple of weeks, they've come back and said, you know what, we're just kidding. We're thinking the economy is in a good spot. So we're going to start to raise interest rates a little bit more aggressively, maybe in 2022. So, that is one of the contributing factors to the market performance that we saw in September, that pullback. As as you're starting to see now, there was almost like the perfect storm of bad news in September with the supply chain issues, with raising interest rates, with inflation fears. Everything really hit at the same time and really pulled back the market in September. And what I want to take away from this is, like I mentioned, we thought interest rates were going to rise so many times. And what this chart will show you is experts are typically wrong when they try to predict where interest rates are going to go, almost all the time. So, and the last 5 years, or I would say 3 years or so, have really been the perfect case study on why you can't really predict where interest rates are going to go. Because you never know what other factors in the economy are going to pop or rear their ugly head at any given time, and then the Fed is going to react by manipulating interest rates. So the takeaway here is don't try to get ahead of it, because timing the market is a foolhardy game, in my humble opinion, and timing interest rate rises or pullbacks is the same. It's the same game. And if you don't get it right on both ends, you're going to shoot yourself in the foot. And like as this chart will show you, that yellow dotted line shows you where investors thought interest rates were going to go, and the blue line is where they actually went. So you can see there is some significant deviation here over the last 21 years. So most of the time, you would have been shooting yourself in the foot over the last 2 decades. And nobody wants to shoot themselves in the foot once, let alone multiple times over the last 20 years. And last but not least, the big catalyst in the September pullback was Evergrande. So who is Evergrande? Evergrande is, as you can see, one of China's largest real estate developers. And why does that matter? It matters because China is one of the world's largest real estate developers. So you have such a major player in such a major market, it tends to be big news. And the problem here was that Evergrande, the corporate, or excuse me, the commercial real estate space took a big hit in the pandemic. A lot of offices, and still are the case, as people adapt to new working environments, a lot of, commercial real estate isn't as valuable as it once was believed to be. So, Evergrande had a balance sheet that it shocked them. They had, this portfolio that would look to be so lucrative at one point at the highest valuations. Now it's like, oh, our assets didn't really match what we thought they would be. So they said, you know what, guys, we may need to file for bankruptcy, which that nasty B word really scares the marketplace because when you hear bankruptcy, many investors get shell shocked and get that PTSD, and they go back to financial crisis and they think Lehman. Oh, when Lehman filed for bankruptcy, that was the domino that kicked off the whole financial crisis and plunged us into doom. So that was the same thought. Investors were really spooked when they heard on that Evergrande may not be able to fulfill its obligations because they had 300 billion worth of liabilities on their balance sheet. So that in fact impacts a lot of people's bottom line if they were to file for bankruptcy. So the market really overreacted to that, specifically in emerging markets. As Shweta showed you, we saw that pullback of 8% in the quarter, and that was mostly in September in response to Evergrande. And then because of that fear that this would be so overarching, because of, like Lehman was, it pulled back in multiple areas. But what was the difference? The difference is that Lehman is a bank, so it does have different financial implications of going under than a real estate developer. And then also, Evergrande survived by the skin of its teeth. So, investors did overreact in the sense that there's a 30-day grace period on the payments. And since that announcement that they may not be able to repay their obligations, Evergrande has made two payments. They barely hit it in by the shot clock. So if it's a 30-day grace period, they got it on day 29 and 30, but they still got the payments in. So investors are less concerned about this now because one, they realize, okay, Evergrande they aren't teetering on the brink of destruction like we quite thought they were. And investors have realized that this is more contained than maybe we originally had priced into the market. So all's well that ends well for now. But I know we've just given you like a Thanksgiving dinner amount of food for thought, but there are some takeaways so you can digest this information a little bit more easily. So Shweta, how should investors be thinking about managing their portfolio going forward?
That's a great question. And I was just thinking, between the Evergrande crisis and all of the different headlines that we covered today, so much of being an investor in today's market is being able to withstand uncertainty. And what smart investing can teach us is that we need to weather these short-term market movements and stay invested in order to increase our long-term returns. And I'll share this chart that's one of our favorites, and not just because it's beautiful to look at, which it is. If you compared some of the charts that we typically have to look at, this is one of the better ones. But this is a great representation of how futile it is to try to predict the market, as Devon mentioned. And what we're seeing in this particular chart is year to year from 2009 to this past quarter, how did each asset class perform if we were to rank them? So the bottom asset classes having performed the worst in those years and the top asset classes being the best performers in those years. So as you can see, in any particular year, there's no one asset class that consistently outperforms the rest. And even if you were to start to see a pattern, so for example, if you were looking at 2014 and 2015, you would see emerging markets trailing the pack in those years. And had you acted on that observation and pulled out of emerging markets, that would have proven to be an obvious mistake as soon as 2016 and 2017. So all in all, it's unwise to predict the market. No one does it consistently. And as Devon mentioned, market timing is something that you have to get right on both ends. And doing that is very rare and typically does not pay off in the way that investors hope that it will. And just as important as diversifying your investments is actually staying invested in the market and taking a long-term approach to investing. So when headlines about government spending or Evergrande start to breed concern among investors, many of them feel the need to act on that feeling. And those who then act impulsively in the short term can have significant consequences, especially if they're trying to achieve long-term financial success through their investments. So we can see here over the past few decades, the US stock market has returned an investor about 8% year over year. And even if you were to miss just 10 of the good days in the market, over those many, many, many years, you would see an annual return that's half of that 8%. And missing even more days in the market, especially the good ones, really drags down on your investment performance to the point where even just 40 good days in the market means almost a negative return if invested in the market. So if there's two things that we can really focus on during this time and going forward, it's staying invested and staying diversified with your investments.
Right. And I think something that also it's the mental implication of this too, that right, if you get
Mhm.
shell shocked and pull out, it's really hard to get yourself back in. We see that all the time with investors that they are still so shell shocked from '08 that they'll have a lot of money in cash because they'll remember, oh, like I pulled out at this time in the market and my loss was 30%. So there are the psychological implications too. So just stay invested. You don't want to miss that run up because you're going to have a tough time getting yourself back in if you pull out at the bottom.
Absolutely. And there's very little that can be said with absolute confidence about the stock market. And that's precisely why we can confidently tell you that long-term diversified investing wins out every time. Volatility is a normal part of investing. And while the tumbles, like the ones that we saw in September, can be scary, they should never be surprising to you if you're a diversified investor and you have a long-term focus and are keeping that perspective. And what the good news is that negative returns are far, far less common than positive returns when you're thinking about a diversified portfolio. So, as much as possible, as Devon mentioned, stay the course, stay invested, and keep your eye on the long-term success of your portfolio.
Well, thank you for coming to our TED Talk. We know we covered a lot today, but there was a lot going on in the market. It was an interesting time. We saw September, like as I mentioned, a lot moved the market. So if there's any other questions or anything like that, feel free to reach out to us. But before we go, we want to talk about health is wealth. So we want to stay not just financially fit, but physically fit as well. So as you know, our very own Laura Miranda, she's fantastic. If you haven't done any of her workouts, please join us on November 4th and November 18th for Strengthen and Tone. They're 30-minute virtual workout classes. They're absolutely fantastic. She's going to get you up and moving. She's going to make you break a sweat. She's going to get you breathing heavy, but you're going to feel great after it. So please join us if you're interested in that. You can see email marketing@Francis Financial. You'll receive a Zoom link and you just join. You can put your camera on if you want. You don't have to. So, whatever makes you comfortable.
And you'll see me at these with my camera on. So if that's any reason for you to feel better about being on camera, I'll be sweating a ton. And Laura's great. I work with Laura also a couple of times a week. So she's absolutely fantastic.
Can't say enough great things about Laura. Great. And then, like I said, if there are any questions, please feel free to email us or call us. Devon at Francis Financial, Short at francisfinancial.com. Our names, emails, and numbers are right there. We'd be happy to talk about this any further, any other questions that you have. We thank you for joining us, and we look forward to having you again.
Thank you so much.